Hi everyone, Danielle Dietrich back again to tell you more about the new DBE regulations that go into effect this week on May 9th. So the topic of today's video is going to be loans and using loans to acquire your interest in a DBE, a disadvantaged business enterprise, or an ACDBE, which is for airport concessionaires. So, a lot of times, folks who are trying to acquire a share of a business, don't have enough cash to pay for the shares. The D in DBE is disadvantaged after all. Most folks don't have a pot of money sitting around that they can easily access to purchase shares outright. So a lot of times they take out loans. Now, historically, this has been a bit of a touchy area within the DBE certification realm. But with the new regulations, there's a little more clarity added and some things that folks should know. So one of the first things that you need to know is that, part of the DBE analysis is they look at ownership and control. And ownership involves having a real and substantial investment in the business. And we'll talk about gifting another day, but gifting is one way you can do that, purchasing it outright. Now, loans. So, loans are today's focus. So, it's really, the analysis to make sure that you really are in a place to control the business. So, one of the things that they put into place was that at the time that you apply for DBE certification, you must have paid at least 15% of the total value of the investment in the company from your own funds. Now, the deadline for that is by the time the firm applies for certification. That means that you can't borrow the entire amount and you need to show that you have some skin in the game. So, for example, if your cost is $100,000 to buy 51% with DBE, just use round numbers on the money. Always have to have at least 51% or more controlling. So if you have a $100,000 loan or purchase, so for a $100,000 loan, you need to have paid off $15,000 of that by the time that you apply for DBE certification. Now, say the purchase price is $100,000, you can put 15,000 of your own money as a down payment and borrow the other 85,000, and that's okay because they look at the value of the shares, not the loan amount, the value of the shares. So sometimes people take out a loan for the whole amount, sometimes they do a down payment. So overall, the magic number is 15% out of your pocket, out of your funds to pay for your interest. So I think that this is a good change because it adds some clarification because certifiers all had different interpretations of this. And so this makes it a little bit more uniform and you know exactly what you're getting into. Some other things that they've stated in the new regulations is that the company cannot be party to the loan. So you can't be borrowing the funds from the company, and you as an individual can't pledge company property to serve as collateral. Now, your shares may serve as collateral, but you can't say, pledge the company truck as collateral for your loan. So that loan must solely be your responsibility. If there is something that needs to be serving as collateral, it needs to be something of yours, your home, your vehicle, a bank account, something. So the other requirement is that you have to make regular payments of the principal and interest according to a standard amortization schedule. So I sometimes see folks get a loan from maybe the seller and it's like, pay me back the $100,000, within the next 3 years with no set time or anything other than the 3 years. So not like $500 a month or anything like that. It's just very loosey-goosey. And that is not okay underneath these new regs. You have to pay on a regular basis. You're not supposed to be skipping payments or deferring payments. You need to pay off this loan over time. So like a balloon loan that's just due at the end is not going to cut it. And that goes hand in hand with these loans have to be real and enforceable, and you can't be in default of the loan at the time that you apply. Everything must be standard, commercial, arm's length terms. That means they have to be fair and reasonable. So if you are in default on your loan at the time you apply, you are not able to get certified. And nobody else can make the payments for you You can't share it, take it out like with your husband or a business partner. Like it has to be you, the socially, economically disadvantaged owner. And you can make prepayments, you can refinance, so that's all okay. Another thing you should be aware of that if the creditor forgives or cancels all or part of the debt, we see this sometimes with maybe a prior owner selling to a new owner. That portion that is forgiven, that's no longer considered an investment. You can't get a free pass on your loan. You have to keep up with your payments or you're going to risk not being able to get certified or not being able to keep your certification. And this loan, you have to show that you're actually using the loan to finance your investment in the business. You can't be using it to pay personal expenses or operating costs. You need to show that it like goes into the business. And you can't have a side deal with, hey, I'm going to pay this, or you're going to say I'm going to pay this, or I'm going to pay you from future profits, or anything like that. That's not going to be okay. And so you can't use a loan to buy or contribute something that doesn't count as an investment, such as an unvoted share, a gift, or a symbolic item. So as you can see, when you can purchase a share in a DBE or a company that wants to become a DBE with a loan. However, there's a lot of little strings attached, a lot of rules you have to be aware of. So be mindful of those if that is your situation. And if you need advice on that, please reach out to me. I'd be happy to work with you on that. And you can reach me. My contact information is underneath the video in the notes. And you can reach me via LinkedIn, Danielle Dietrich, or through my email, ddietrich@Potomac Law Group. Thank you, and I'll see you next time.